Private credit får mycket uppmärksamhet på marknaden och skapar en hel del oro på en ganska volatil räntemarknad, även ur ett bredare perspektiv. Med oss för att diskutera detta har vi Marianne Zangerl, your Deputy Global Head of Fixed Income with Aberdeen, and it's wonderful to have you here in Stockholm. Thanks for coming.
Lovely to be here, thank you.
Private credit is a bit of a newbie. I mean, it's been around for years. It's been growing as an investment form. Should we be worried about this new thing that's now causing some headlines?
It's a great question, and there have been a lot of headlines of late, and a little bit of finger pointing, I think, is fair to say in the market. It's not a new asset class, I think I would say. You know, it's been a space, private credit is a space where the banks have traditionally been, and non-bank institutions are increasingly stepping into either as a response of banks pulling back because of regulatory restrictions, or just investors looking to, you know, diversify where they're allocating.
What if I were to say that this is the stuff that the banks doesn't want to do? They don't want to do it themselves. It's too risky. It's too bad.
I mean, I think they would love to do it themselves, but the regulatory constraints are so penal for holding lower rated companies that it is actually more capital efficient for them to start shifting some of those assets off the balance sheet. But they are very active still in this market, in this space. They do a lot of the underwriting. They regularly get involved. The leverage loan market is a source of funding for a lot of these companies as well. So this whole debate, you know, private credit versus banks, it's a very interrelated market.
There's been a lot of headlines about American firms sorry, now I lost the name. First Brands is obviously the big one. Auto parts, very pressed segment, having a bit of a bad loan, using the same security to take money. A bit of bad behavior as well. Is this something that you see spreading? I mean, there's certainly a bit of credit loss concern all across the world right now.
There is. And I think in the case of First Brands, there has been a lot of focus on, you know, fraud and whether that was committed. And I think, you know, it's important to look at that in the context of this is an isolated company. But what is interesting, and I think what the market is picking up on is that a read-through to a loosening in lending standards? And do we need to be concerned about that? And you know, I do think that there has been a loosening in lending standards. It's been across private credit. It's been across leverage loan market. You've seen covenant light structures in place for a while. And we do expect to see that there will be continued defaults, and there will probably be a consolidation across lenders in the private credit space as a result of that. But it's not going to be this systemic shock that everyone is worried about, and sort of forecasting is going to happen. It's a small part of the market, and it is very much a market that has been around for a long time.
So the worst is yet to come, but the worst is not going to be so bad that it becomes a systemic risk. That's the gist of.
Exactly, and it is. You know, there's also important to highlight, there's a broad spectrum in this private credit space. So you have investment grade, private credit, very different risk profile to this part of the market that First Brands is in. You know, we do a lot of asset-backed lending. Again, very different profile. You've commercial real estate debt, infrastructure debt, fund finance. These are things that you can go in, take control of the assets, take control of your security, and enforce. A very different space to what we're talking about.
Is there a functioning secondary market for this kind of debt?
It's interesting. So there's a lot of questions around liquidity, particularly as you see more retail investors look to increase allocations to private credit, private markets more broadly. And it's something that we have flagged as an issue that needs to be considered. We need more transparency. We need better processes around valuations. But it is, you know, I think what we're seeing is a merging between public and private credit. And you see investors now, when they think about value, they're thinking, you know, in my mandate, I might allocate to public, I might allocate to private as well, and I'll go where that relative value is. So as that increasingly starts to happen, and we increasingly see some of the main private credit players start to look to provide liquidity, that dynamic's really going to shift. So I think it's actually quite an exciting time for private credit in terms of what's going to happen over the next few years.
All right, an exciting time in the bigger perspective, but still a concerning time in the couple of month long perspective.
Yeah, I mean, I think over the short term, we need to watch and we need to monitor. But like I said, I don't think it's going to be systematic. I don't think it's going to hugely impact on the big chunk of the investment grade private credit market out there.
Let's flip the switch. Does it create an investing opportunity when there is a bit of concern? Do you see volatility that moves prices?
Absolutely, you do, yeah. And I think that's, one of the things with private credit is it does tend to lag public markets in terms, largely in the investment grade space, you will look to index it to public market spreads and how they're performing. But there is a lag there. And when you do see risks like this come through, there is an opportunity, pricing around COVID, it was great. That was an opportunity where you could actually get a lot higher spreads and you lock those in for the long term. So there is definitely an opportunity here.
Could we mention, if you mentioned COVID, we had a big corporate bond scare in Sweden and in many markets for that sake, to a great opportunity in hindsight. Could we talk a little bit about bond market volatility more broadly? This is a nervous week for stocks. Do you see this kind of nervousness on the bond side as well?
Yeah, I mean, it's been, weeks and weeks of sort of nervousness, volatility, watching that play out. I think it's an exciting time as a fixed income active investor. Volatility equals opportunity. So we are, I'd say, cautiously optimistic about the credit market and the outlook there. We are taking defensive positions, so we're not piling into cyclical sectors. We're much more focused on non-cyclical like utilities, healthcare, real estate. But we do think that the corporate bond market is fairly well supported in terms of the technicals. So you've seen a lot of money sitting in money markets funds. I mean, that has to come off the sidelines as rates start to come down. But you're also seeing a lot of interest in the asset class because it is such an attractive all-in yield at the moment. So spreads are very tight, but the all-in yield is looking very attractive versus historical averages.
We started with private credit. We went upwards to corporate bonds. I want to end in a government debt space. There's been a lot of discussions about French debt, of course, a source of concern. Any thoughts on that? Would you invest in, if you like volatility and bad times as entry points, would you go into French debt right now?
Yeah, so we are fairly constructive on French debt. The market has shown a willingness to digest the bad news around France. And we don't think that it's, unless the government collapses and we see Macron forced out, we don't think that we'll see huge reactions from the market. So whilst, there is volatility, instability in the political system, the market has shown, it's taking down supply. And fundamentally, France is a key part of Europe and a key part of the Eurozone. And the expectation is that it will continue to remain so. That said, investors are increasingly thinking in portfolios that maybe didn't have exposure to countries like Spain and Italy, whether now it's a good time to diversify, pick up some exposure to Spain in particular, which has a very attractive rating for people more focused on higher quality sovereigns. But there hasn't been a huge knee-jerk reaction to selling France. So investors are thinking about it in the whole and thinking, there is volatility there, but it will continue to remain a key part of Europe.
Lastly, the stock market concern that we've seen this week, does it translate or does it move over to the bond side at all, or do you live in separate worlds?
I wouldn't say we live in separate worlds. There is, that element of market contagion that comes through any volatility. But we are seeing attractive entry points for credit, and we are somewhat, we haven't seen the extreme volatility that you are seeing in the equity markets.
Marianne Zangerl, very nice to have you here in the studio. Thank you very much.
Thank you.